Friends, good afternoon. Thank you for joining this session of exam techniques on papers 2.2, CA2.2, and DA9. Welcome to the Zika virtual exam techniques meeting presentation on these two papers. My name is Leonard Mwansa. It is hoped that the discussion of exam techniques, some common errors committed by candidates, and illustrative exam questions will greatly contribute to your success. Before looking at some illustrative exam style questions, it is worth considering some of the things which go hand in hand with exam techniques and lead to exam success. These include 1, question practice, 2, revision, 3, use of 15 minutes reading time, 4, timing, 5, workings in quantitative papers, 6, discussion questions, 7, gaining easy marks, 8, first, you need to read requirements, 9, passing exams easily, and 10, failing exams easily. Let me talk about these 10 elements in more detail. Revision. A good approach to revision and exam preparation leads to exam success. This is because even if a candidate is good at answering exams, poor preparation, poor technique, and poor revision may still lead to failure. Therefore, plan your revision with a good revision timetable. Do not revise selectively, that is cherry picking, e.g. skipping syllabus areas you don't think will come up, or skipping difficult topics. For example, budgeting and variances. In short, cover the whole syllabus. The Zika syllabuses are devised in such a way that nearly all units come up in each exam dart. In your revision, practice calculations as well as written parts of questions, not just either. Use of the 15 minutes reading time. Do not arrive late for the exam. You miss the glorious opportunity to increase chances of your success. These minutes help you to calm your nerves, fear, and panic. So use this time to adopt an overall approach to attempt questions, from your best questions to the worst questions. Don't start with your worst questions by thinking, I know the best questions, so let me first deal with the worst. You'll be making a mistake. By starting with your best questions, you're going to pick up the morale, which psychologically will help you tackle your worst questions. Read question requirements. We shall later look at advantages of reading requirements. Remember, this is not the time to answer questions, but to plan the attack. You are allowed to make any planning points on the question paper, except that you should not, during this time, transfer anything to the answer booklet, or else you'll be in trouble with the invigilator. Importance of timing yourself. Timing yourself is very important so that you do not run out of time and attempt fewer questions. Attempting fewer questions is one of the reasons for students failing exams. Importance of workings in quantitative papers, like the DA9 and CA2.2. Workings are very important. In actual work situations, workings are called schedules or appendices. So start practicing now. Cross-refer your workings to the solutions by numbering your workings or provide them as footnotes. For example, in relevant costing questions, relevant and irrelevant items are explained in numbered footnotes, which are then cross-referenced to the statement of numerical figures. Next, discussion questions approach. You must plan an essay before you start writing. Your essay should have ideally a structure, such as a brief introduction, a main section, and a conclusion. Don't waste time by restating the question at the beginning of your essay. I do encounter such a number of scripts whereby candidates rephrase the requirements, not even rephrasing, they copy down the requirements. It's a sheer waste of time, valuable time. Use subheadings and numbered sentences if they help show the structure of your answer. Gaining easy marks is very important. Most students do not know how to do this. But this could make the difference between passing and failing. For example, in cash budgeting questions, do a pro forma cash budget, then slot in figures like opening cash balances. This is generally freely given. And those figures incurred monthly or quarterly where no workings are required. If a question asks for a report format, such as to, from, date, signed, normally that format is allocated marks. With 1 mark, 2 marks, 4 marks. And those are easy marks to pick up and could make a difference between passing and failing. Even a pro forma without figures in it may be allocated marks. A pro forma for example, a reconciliation statement. Make such a pro forma and get his marks. A list of other financial factors to consider in decision-making may earn you easy marks. But some candidates just end up at the calculation stage. When they ask for what other factors to consider, non-financial, before they make the final decision, they leave that blank, thereby losing easy marks. Reading requirements. The advantages of reading requirements first before reading the question or scenario are, 1, it reduces wasting time. You first read the question, then when you go and read the requirement, then that's when you discover that, so this is what they are looking for. Then you go back and start reading the question or the scenario. So reading the requirement reduces wasting time. It also reduces the risk of answering the question you want to answer and not what the examiner has said. 3, it also helps in that your answer remains relevant. By referring to the requirement, it means that you continuously bring up points which are relevant to that requirement. Passing exams easily. Read questions carefully. 2, the requirements will indicate or suggest to you what subject areas are being covered. This can be alluded to the previous slide on the advantages of reading the requirements. In that, once you read the requirements, they will tell you what subject areas you are going to look for as you start reading the question or scenario. What issues to discuss, what techniques to use, they'll be in the requirements. Information and examples to include. Passing exams easily. Number 3, writing answers that contain only relevant material. Passing exams easily. 4, using material in the scenarios to support your answers. Refer to the name of the company. Refer to the figures there. 5, making reasonable recommendations that follow from your discussion. The opposite is failing exams easily. 1, not attempting sufficient questions. For me, this is one of the, in the marking situation, in my marking so many scripts, this is one of the reasons for a number of candidates failing. Some do not even reach half of the answer booklet. Not attempting sufficient questions. The marker is not going to, the examiner, the marker is not going to give marks where there are blank spaces. Failing exam easily. 2, including relevant material. That's brain dumping. Anything that you know. 3, not making use of the scenario material, particularly at higher levels, like at the advisory levels. 4, not answering the question, e.g. providing bullet points where a discussion is required. 5, poor presentation, that is illegible handwriting, no workings, no question numbering. By so doing, you are not preparing yourself for a working situation. Next slide. At this point, we can have a health break. After the break, we'll look at the common mistakes which were reported in a number of exam darts. So we have a health break now. Welcome back. We shall look at the common errors committed and the possible remedies to those errors in each of the exam dates March 2022 to March 2023. But some of these are still recurring in 2024, 2025. Some of the common mistakes complained by the examiner's markers included not attempting sufficient number of questions that I alluded to earlier, leaving a number of subsections blank. By this we mean answering A, then skipping B, answering D, skipping C. So of course this leads to loss of marks, and inevitably failing. In budgetary control, comparing fixed budgets with actual results. Later on, when we look at a flexible budgeting questions, we are going to note that you do not compare a fixed budget with actual results. you compare a flexed or flexible budget with actual results. So candidates, as common mistakes, the number of them continue comparing fixed budgets with actual results, thereby getting meaningless variances and therefore meaningless recommendations or advice. Avoiding calculations and attempting only written parts of the questions, and vice versa. Or attempting written parts, essay parts, and avoiding calculations. Next common mistakes. Writing all that a candidate knows about a topic, even if it is worth only 1 mark. Full page, 1 mark. The marker will appreciate what you have written, of course, if it's correct, but they can only give you 1 mark and no more. But will have wasted valuable time, especially in these management accounting papers. They are time pressure papers. Please note that the number of marks indicate how much you should write. Next, failing to come up with sufficient points asked for. For example, the question asked for 6 limitations, that's in December 2022, of cost plus pricing method, but some candidates gave only 2 or 3 limitations, so lost marks here. Advice: underline the 6 limitations in the requirement. Next common mistake: mastering computations without having a detailed knowledge of the theory behind the computations. Like computations on return on capital employed, cash operating cycle, profit margin, asset turnover. Knowing how to compute this, but failing to interpret the result of these calculations. So there is need for students to focus on both the theory and the computations of any topic that they cover. A short break. Next, we'll look at the variances, because now we'll be going to, yes, our variances. Welcome back. Welcome back. Variances. We look at basic variances and advanced variances. Basic variances are covered at the diploma level in the DA5 paper, but in the CA2.2 paper, both basic and advanced variances are covered at the same time. The basic variances include material price, material usage variances, labor rate, labor idle, labor efficiency variances, variable expenditure variances, variable overhead expenditure variances, variable overhead efficiency variances, fixed overhead expenditure variances, and fixed volume variances. Fixed volume variances are divided into fixed volume capacity variance and fixed volume efficiency variances, and sales price and sales volume variances. These are what are known as basic variances. And at the diploma level, these are covered in the DA5 paper. The concentration in the DA9 paper is more on the advanced variances, but in the exams, even the basic variances are also included. Now, something to note about variances. Usage, please note that usage and efficiency variances use actual production in their calculation. Whether you're using a formula approach or descriptive approach, for you to calculate usage variances and efficiency variances, make use of the actual production in your calculation. Also note that labor idle time variances are always adverse, because idle time is a bad thing. Idling is a bad thing. So the variances are always adverse or adverse, if that is your pronunciation, or adverse. Yeah. Labor efficiency hours, also note that labor efficiency hours and variance signs, whether adverse or favorable. By variance signs, we mean adverse or favorable, are the same for variable efficiency and fixed overhead efficiency. In other words, as we will note when we look at the question, if you have calculated the labor efficiency variance correctly, then there is no need, that's in hours, there is no need for you to calculate again the variable overhead efficiency hours. There's no need to calculate the fixed overhead efficiency hours because they'll be the same. If under labor efficiency hours, you calculate 10 hours favorable, it means that even under variable overhead efficiency, there will be 10 hours favorable. The sign also will be the same. Even under the fixed overhead efficiency, there will be 10 hours favorable. Next, something to note on fixed overhead expenditure variances, don't flex the fixed overhead expenditure variance. In other words, use the budgeted fixed overhead and subtract the actual overhead to calculate the variance, the fixed overhead expenditure variance. By flexing, we mean don't say what it should have cost, what the budgeted fixed overhead should have cost or should have been. No, you take, as you note from the question, when we look at it, you take the fixed overhead, budgeted fixed overhead from the question. Then compare it with the actual fixed overhead. The difference is the fixed overhead expenditure variance. Capacity variance. Something to note on capacity variance, express it in hours. If the capacity is given in units, production units, convert it to hours. Convert the units to hours. I do see candidates finding the difference between budgeted units and actual units, and then calculating that as capacity variance. It's a wrong approach. Next. Don't include fixed overhead volume and capacity and efficient variances in the operating statement. The operating statement is the statement of reconciliation. Don't include all these three in one operating statement. If you do so, this will amount to duplication. So it is either fixed overhead volume only or capacity and efficiency variances only. So something to note there. That's all on basic variances. Now we move to advanced variances, which are mix and yield variances, and planning and operating variances. So we start with mix and yield variances. The materials usage variance can be split into mix and yield variances. In other words, the material usage variance can be explained by the mix variance and the yield variance. Now, material mix variances. These are calculated, or when are they calculated? They are calculated if 2 or more ingredients are required. If a product simply requires one ingredient, or one material, then you can calculate a mix variance. Only if 2 or more ingredients are required. For example, in baking a cake, you might require butter, water, flour, sugar. So there you have a number of ingredients. In that way, it is possible to calculate a mix variance. Now, when does a mix variance occur? A mix variance occurs when materials are not mixed in the standard mix. For example, a good example again is when you look at baking. Normally, the recipes are indicated there, the ingredients. Maybe 2 eggs, 2 teaspoons of sugar, and so on. So if you change, for example, and just include 1 egg, then there, the mix is going to change. And probably the cake is not going to taste that nice. So the mix variance occurs when materials are not mixed in the standard proportion or standard mix. Mix variance calculation. You multiply the mix variance in kgs or liters by the standard price per kg or liters. Because the mix variance is coming from the usage variance, you value the variance at the standard price, just like for usage variances. You value them at the standard price. You find the difference between what quantity should have been used and what quantities were used. Then the difference you multiply by standard price. So similarly, the mix variance, you multiply that variance by the standard price per kg or per liter, as the case may be. In planning and operation of variances, value the mix and yield variances at the revised standard price. At the revised standard price. Still standard price, but at the revised in planning and operating variances. Next, variance signs interpretation. If a mixed variance is favorable, what it means is that more of a cheaper material was used in the mix. It's what we're talking about, tackling also discussive parts of the question. Students or candidates may be able to calculate a mixed variance, but failing to interpret what that mixed variance means or what it is. So if your mixed variance is favorable, it means that you have used more of a cheaper material in the mix. I'd like to bring out this when we look at the question on mixed variances. If the mixed variance is adverse, it means that more of an expensive material was used in the mix. We move to yield variances. Yield variances, it is a totals variance. That is all the materials used in the production. What does it show? It shows the efficiency of usage of all materials in the mix. It shows the efficiency of usage of all the materials in the mix. So if the product requires materials X, Y, Z, it will indicate how efficiently you have used a material X, material Y, and material Z. Yield variances, continuation. The calculation uses actual production units in the, uses actual production units. It makes use of actual production units in the calculation. Already I'd indicated that usage variances and efficiency variances, they make use of actual production units. So since yield variances are derived from material, or they explain or derived from usage variances, they also make use of actual production. The evaluation of the variance. How do you value the yield variance when you find the difference? To put a monetary figure there, you value you value such a variance at the weighted average standard price per kg or per unit if the yield method is used. Because here you can use two methods, either the input method, output method, which is also known as the yield method, but you get the same answer. Then we move to the sales mix and sales quantity variances. These are also advanced variances. Sales mix and sales quantity variances. The sales volume margin variance or sales volume contribution variance. Sales margin variance is when the company uses absorption costing. Sales contribution variance is when a company uses marginal costing in the operations. So the sales volume marginal contribution variance can be split or explained by the sales mix and sales quantity variances. So we don't say sales yield, but sales quantity variances can be explained or split into sales mix and sales quantity variances. Sales mix variances. When is it calculated? It's calculated if a company sells 2 or more products. A company which just sells 1 product calculate a sales mix variance. But a company like Trade Kings, producing products Banja, Boom, sorry for that, cornflakes, and so many products. They have so many products in their product range. In that case, you have when does it occur? When does the sales mix variance occur? It occurs when products are not sold in the standard mix. It occurs when products are not sold in the standard mix. Sales mix variance evaluation. You multiply the mix variance in units by the standard profit if you use absorption costing, or contribution per unit if the company uses marginal costing. Variance signs interpretation. If the sales mix variance is favorable, it means that more of a profitable product was sold. Otherwise, if an adverse variance is calculated, it simply means that more of a less profitable product was sold. Sales quantity variance. Like the materials yield variance, it's also a totals variance. It's the difference between all the products sold, actually sold, and all the products that were budgeted to be sold. What does it show? It shows the efficiency of sales achieved by the sales team. That is, whether the quantity sold of all products were more or less than those budgeted. Valuation of the total sales quantity variance. You also use the weighted average, standard profit, or contribution per unit. So the difference between all the products that were sold and all the products that could have been sold, that difference you multiply by the weighted average standard profit if the company uses absorption costing, or the weighted average standard contribution per unit if the company uses marginal costing. We move to the last portion of the advanced variances. That is planning and operating variances. Any traditional variance, a traditional variance is one that we are familiar with, calculated by comparing the budget with the actual results. That's a traditional variance. Such a traditional variance can be split or explained by the planning and operational variances. The traditional variance can be explained or split into planning and operational variances. Planning variance. This variance is due to faulty standards or errors in the original plans. Planning variance explains the extent to which you are at fault in planning. You know, normally we always blame the actual result. But even the standard can be 40. Poor planning, poor estimations. So the planning variance explains the extent to which your planning process was not accurate, was not correct. How is it calculated? It's calculated by comparing the revised standard with the original standard. Because it's explaining the extent to which the original standard was at fault. So you bring in the revised standard, with the benefit of hindsight, what standard should you have incorporated? So planning variances are pro. In other words, planning variances compare revised standard with original standard. So there are no actuals there initially. And the other thing to know is that they are uncontrollable by junior managers. So things to know. What is the planning variance? The planning variance is one which is due to 40 standards. How is it calculated? It's calculated by comparing the revised standard with the original standard. Then the other major thing to know about this is that they are uncontrollable. They are uncontrollable. Now, the variance signs. If you are dealing with costs, when the revised is greater than the original, the variance is adverse. Whilst if the revised is less than the original, the variance is favorable. I could go into the reasons why these variances, but you may have to get them like that. Otherwise, I can say that if the planning variance is adverse, it is because the original standard understated the costs, thereby overstating the profit. Because here we are saying the revised standard is greater than the original. Maybe the revised should be 20, but the original was 10. So by putting 10 in the costs, you unnecessarily overstated the profit. So to correct it, you pass an adverse planning variance so that you reduce because you had overstated. That's why it's, and similarly for a favorable variance. Okay. Next, if dealing with revenues, signs are opposite to those of costs. So if the revised is greater than the original, then the variance is favorable. Actually, you should take the revised as actual because that's a realistic. So if it's the revenue, if the revised is greater, say revised selling price is 15, but you had put 8. So the variance there is favorable. 15 minus 8, 7 is favorable in the sense that actually, when you sold realistically, you were raising more money than what you had thought. You made a mistake. Actually, you are selling at a higher price at 15 compared to the 8 that you put in the budget. That is the, or else you can just lend them like that. When the revised is greater than the original, it's favorable. Next, go to operating variances. These are caused by adverse or favorable performance. They are calculated by comparing revised standards with the actual results. So revised is still there, just like in planning variances, but you compare with actual results. In planning variances, you compare the revised with the original. In operating variances, operational variances, you compare the revised standard cost, standard price with actual results. So operating variances are ORA or ORA. operating variances compare the revised with actual. Let me just bring the arrows and give you a pointer. Yeah, so operating variances compare R and A, revised against actual. Whereas planning variances are pro. They compare R with O, revised with original. Next. Oops. So the same way you decide variances with traditional variances, that's how you decide with operating variances. So planning variances, you have to be careful how you decide the sign. But I indicated there, if revised standards are greater than the original, then it's adverse. And the opposite is the case. If the revised is less than the original, then it's favorable. But with operating variances, no problem. The way you decide with traditional variances, that's the way you also decide on operating variances. So if they're revised, it's still standard, albeit revised. Revised standard actual. So when the standard, in terms of cost, when the standard is higher than the actual, you have a favorable variance. In other words, the actual cost is less than the standard cost. Okay. Next, if dealing with revenues, the variance signs are opposite to those of the costs. Then we move to the sales margin variances. Also, they are considered to be advanced variances. The sales margin volume variance can be split into market size variance and market share variance. Market size variance indicates a change in the marginal contribution due to change in the size of the market. Change in the size of the market. So if overall the size of the market grows in the economy or in the world, it's possible that your margin or profit or contribution can increase. So the change in the market size might be due to economic factors such as recession or boom. So of course, if there is a recession, then there is a general decrease in the market size. If there is a boom, there will be an overall increase in the size of the market. So those who take advantage of, say, a boom, they are likely to have higher profits, higher contributions. And those who don't take advantage of such, they are going to have less profit. And so this measures whether you took advantage of the situation or not. The market size variance is calculated like planning variances. Planning variances are so you compare the revised with the original, and the variances are uncontrollable. Planning variances are uncontrollable. So even these market size variances, they are uncontrollable by junior managers. The market share variance indicates a change in margin, that is profit, or contribution as a result of change in the market share achieved. The adverse market share variance means a decreased market share and vice versa. In other words, if a favorable market share variance means an increased market share, whereas an adverse market share variance means a decreased market share. Market share variances are calculated like operating variances. They are ORA. So you compare the revised, for example, market share with the actual market share achieved. And they are controllable. Operating variances are controllable, so even market share variances are controllable. At this point, let me pause a bit before we start looking at question 1 on variances. This question is from the DA9 diploma, paper March 2024. It will incorporate basic variances, advanced variances planning, materials mix and materials yield variances, planning and operational variances. So it was a question which, it was actually question 1, and it should have been compulsory. Questions 1 and 2 in the DA9 paper are compulsory. So this was a compulsory paper, and the examiners there included basic variances, planning and operational variances, mix and yield variances in one question. Okay, so just a short break there for 1 minute. Then we can look at this question, or I can give you time to read through this question. For these materials were shared, you can have a read through this question. Okay, welcome. We can practice what we learned or what I put across by reading the requirements. But this question, worth 10 marks, required the following calculations. Calculate the following variances: material price for each material and in total. So each, bear in mind that each and in total. Materials mix variance for each material and in total. Materials yield variance in total. So as you go to read the question, at least now your mind will be focused. Yes, for mix and yield variances, you have to pick the individual materials there. We said you can only calculate these variances if you have 2 or more ingredients. So just this part, the question says, slide it is 46, we go to 47. Slide 47. The question says very quickly there, a company uses a batch production method to produce a single product or combine 2 materials, yen and zen. The company has budgeted for a materials mix ratio of 60 to 40, or 6%, 40% for yen and zen, respectively. Yen and zen are the materials. The following standard cost information relates to each batch. Standard, so everything here down there, that's standard. Be using what it should have cost, what should have used. Yeah, direct material input 240, that's the standard. Then yen standard price is 2 kwacha per kg, Zen 3 kwacha per kg. Standard yield 200 kgs of product. So there should be a loss there because you input 240, then you get out 200, meaning that you lose 40 in the process. It could be a normal loss, or yeah. Yeah, then the 2, 3 will be used for valuing the variances. I said, for example, mixed variances, they are valued at the standard price. So 2, 3, oh, yes. Then the next slide, where the requirement is 48, actual results. So the other part there now, actual results for month 11 were as follows. It's important to know what is actual, what is standard. So on the next slide, above the requirement, everything there is actual. So we compared in the standard things on slide 47 with the action slide 48. Output 18,000 kgs. Material Zen 14,020 kgs, used 14,020 kgs were used, and these cost 26,638. Material Zen 8,980 kgs were used and purchased and used, and they cost 28,736. You are required to calculate the material price variance for each material and in total. That is a basic variance. Then 2 and 3 are what we can call advanced variances. So if I take you to the solution in the interest of time and just explain a bit there. First, for material price variance, you are going to compare for material Y or Zen, 26,638 with what the 1420 should have cost. So you multiply 1420 by 2 kwacha on slide, that's where the price is, on slide 47. Pardon me. On slide 47, 2 kwacha. And for Zen, so the difference then will give you the price variance there. Then for Zen, the cost of 28,000, the actual cost of 28,736 will be compared with what it should have cost. The same way it's 980, which cost 28,736. What should it have cost? You go to the standard. When you say what it should have cost, you go to the standard cost card and pick the selling price there. Sorry, the purchase price, which is 3. Back. 3 here. 3 pointer 3. So you multiply that 80 by 3. Then you compare with the 28,736. So at this stage, let me just take you to the solution somewhere. Yes, it's fast. Or before that solution, there is some write-up there. Go to the question. Requirements, I like the verbs, another reading words like verbs like calculate. So when I went to the requirements, then the verb is calculate, that examining verb. Then allocate the time, 10 marks, require 18 minutes, and then start answering the question. Okay. Then what I'm saying there in part A, you may use formula or descriptive approach to calculate variances. The chartered accountant or Zika text use the descriptive approach, and this is what I'll be used. The descriptive approach is where you say what it cost and what it should have cost. You find the difference. How much was used, what should have been used. How much time was taken, how much time should have taken. That's the descriptive approach. And the Zika text use that. You may use the formula approach, but this approach encourages memorizing rather than understanding variances. And once the formulae are jumbled up, a dark cloud is drawn on such students. But if you are comfortable with the formula, you can use the formula. Like the price variance is simply the difference between the standard price and the actual price times the actual quantity purchased. Okay. But as I mentioned, we're going to use a descriptive approach. So there we are on slide 54. That's where the solution to A1 is. So you can see there, I put also the formula there, but I'm using the descriptive approach. Standard cost 1420 times 2, get 28 that. Actual cost 14 times that. You will note that in these lines, you have the same figures. 1420 costs, then you go there. 1420 should have costs like that. Similarly for materials then, 8980 should have costs 8980 costs 28730. You pick it from the question. Then what it should have cost, the standard cost, 8980 should have cost that. 8980 actually cost 28720. But if you had stuck to the standard, 8980 should have cost multiplied by 3, should have cost 26980. So you spent more, and therefore you have an adverse variance there, 1796. Then the question also asks for the total. Otherwise, you will lose the marks for the total. So you add 1402 favorable to 1796 adverse, and you get, large total, net total 3 something. Okay, that is A1, A2. And we have not yet ended the 10 marks. 10 marks also asking for the hued and mix. That's when you get the 10 marks. So then materials mix variance. Let me just explain from the solution viewpoint. Take you to the solution. Yeah. Down there, fast forward on the notes I'm saying, in note 2 there, learn the mixed variance pro forma format given in the Zika CA text, and you always get the mixed variances correctly. Okay, so what is there? That solution, that is the way the Zika text doesn't use formula, what have you. That's a pro forma use. So start with the actual column mix, get the actual kgs used, and for yen, and actual kgs used for zen. The total was 23. Then you analyze it in the proportion, which was 60 to 40. So you multiply 60% on 23,000, that is 13,800. And 40% on 23,000, that is 9,200. Then you find the difference between the two. 13,800 minus 14,020. The variance is 220 adverse. Okay, why is it adverse? It's because you actually used more, there 14,000 instead of 13. So it's adverse. For Zen, you should have used 9,200 in the mix. You only use 8,980. So you have a favorable. And the variance for mixed variances is always it always sums up to 0. If you find a figure other than 0, then it means that you have made a mistake and you should go and check yourself. It's always 0. Okay, and the signs are, say, adverse and favorable. Then we say that these variances are valued at the standard price per kg in this case. So 2 times that, 220, 3 times 220, we get those variances in kwacha, and the total is 220 favorable. Okay. Then for the yield variance, you take the actual yield. Okay, in the question, the actual output was 18,000. So that's the actual yield, 18,000 there, kgs. Then you say, well, they used 23,000 in total. You know, as we noted, materials yield variances are totals variances. They are totals variances. So you add up the kgs for Zen and for yen, and those are 23. We have noted that one on the mixed variance. They added 1420 plus 89, 80. That's a 23,000. Now, in the yield variance, we are saying, if we use 23,000 kgs to produce 18, or an output of 18,000 kgs, what should we have yielded from 23? Were we efficient or not? So according to this calculation, 23,000 kgs should have used SHY. It should have used 19,167 kgs, but we used, sorry, should have yielded 19,167 kgs. That is more, but we yielded only 18,000. That's why it's adverse there. 1167. In other words, we should have produced more by inputting 23,000 kgs. But from 23,000 kgs, we only got 18,000 instead of 19,167. So that was an adverse yield variance. Then in the concepts, we say that you value such variances at the weighted average cost per kg. So you do a working. You go and do a working there. That's a working there. And it gives you a weighted average cost per kg of 2.88. And that is the figure. I can take the arrow there. That is the figure here that you bring there and multiply by this. 1167 times 2.88. This is 3,361 kwacha adverse. 3,361 kwacha adverse. Okay. And you can follow. So we are using the principles also. It's a totals variance. So we have used totals here, total 18,000, total there. Then we value it at the weighted average cost per kg. This is what's called the output method. You can also use the input method, whereby you start with 18. Yeah, that 18 kgs require 23,000. Okay. Yeah, okay. Fine. Then we go to part B. Part B requires us to calculate the planning variance. So if I take you back to the question, part B. Maybe I go to slide 49. The question says the above company operates a standard costing system. The following information has been extracted from the standard cost card for another product when budget production 1,500 units, that material cost 7 kgs at 4.1 per kg. Oh, this is standard. This is standard. The 1,500 is standard. There, told that is a standard cost. So everything here is standard. Everything here is standard. Okay. So we have budgeted production, 1,500. That's not what they budgeted. Direct material costs, that's 7 kg standard, 4.1 standard, and even 28.70 standard. Then the actual results, actually it's up to here. Yeah, yeah. Yeah, I just want to pick the standard properly. Also, yeah, that's the standard information. Then actual results for the period were as follows. We have production, 1,600. So that is actual. The 1,500 was budgeted. Direct material purchased and used, 12,000 kgs, costing 52,200. Costing 52,200. Everything here is actual. 12,000 is actual, 52 is actual, 1,600 is actual. Okay, then the next slide, 50. The question continues. It has subsequently been noted that owing to change in economic conditions, the best price that the material would have been bought for was. So when you have such language with the benefit of hindsight, the realistic price should have been, even here, the best price that the material will have, it's now telling you that that's revised. So 4.5 is a revised cost. The 4.1 on the previous slide there, 49, the 4.1 per kg was the original. Then on slide 50, the 4.5 is the revised. For planning variance, you're going to compare the 4.1 to 4.5. Yes. The material price planning, required. Calculate the material price planning variance and the operational material usage variance. Okay, again, fast track there, and also in the interest of time, I take you to the solution and just explain things through. Okay, so slide 57, that's where the solution is. Question slide is on 49 and 50. So slide 57. So revised standard cost, 7 times 4.5, because the revised price was 4.5. So the revised standard cost per unit, this one is per unit. The 31.5 is per unit. Even the 28.70 also is per unit. So like with like, per unit. Okay, so we find the difference. Some are saying, why not 4.5 minus 4.1? Even that one, I think I should have various versions. Even that one, you can still use it. But here we want per unit. You can also do it per kg. 4.5 is per kg, 4.1 is per kg. You can also do it that way. But one option is per unit. So 31.5, that's per unit. That's the revised cost per unit. Then the original cost per unit is 28.7. So the variance is 2.8 adverse. Why is it adverse? There we noted that when R is greater than O, it's adverse. When R is greater than O, it's adverse. Okay, because we included a lower price or lower standard costs in the budget. So your budgeted profit was higher, but the actual reality is that should be lower by 2.8. So you pass a 2.8 adverse variance. Okay, that's per unit. Now in total, since you produce 1,600 units, then you multiply 1.6 by 2.8. So the adverse variance total planning variance is 4,480. And I put there R is greater than, so adverse. Okay, next, I think the usage. Those are the alternatives. You can work per unit, per kg or in total, you get the same answer there. Okay, then the operational materials usage variance. The question is on slides 49, 50. So the operational variance compares the revised with the actual. So the actual cost of 1,600 units was 12,000. Sorry, I'm sorry. It's a usage variance. The actual usage, 1,600 units used 12,000. That's actually a comma there. 12,000 kgs from the actual information. But then if you had stuck to the standard, the same 1,600 units should have used how many kgs? So according to the standard, each unit should use 7 kgs. So 1,600 units times 7 kgs, they should have used 11,200. So you use 800 kgs more. Instead of 11,200, you used 12,000, 800 more. And then you value it at the revised. Again, if we go back to the concepts there, you value in planning and operational variances, you value these variances at the revised. So we have used 4.5 and not 4.1. 4.5 revised, giving us a cost of 3,600 adverse. And put there value usage variances at the revised. So get the concepts. Okay, next. The next variances are basic variances. Yeah. Labor rate. So I can go to the question, otherwise I could have skipped this one since it's basic. Most of us do not have a lot of problems on basic. But if you want to go to the where the question is and the requirements, is on slide 51. It says Tabo Limited budgets to produce 10,000 units of REN. So we have Zen, we have Yen, we have Wen, now REN here, each requiring 45 minutes of labor. Labor is charged at 20. The whole of this question, mind you, it was question 1 of March 2024 DA9. Labor is charged at 20 per hour and variable overheads at 15 per hour. During April, 11,000 units were produced. 8,000 hours of labor were paid at a total cost of 168,000 kwacha. Variable overheads in April amounted to 132,000. You are required to calculate. So the examining verb is calculate. To calculate C1, the labor rate and labor efficiency variances. Then C2, the variable overhead expenditure and variable overhead efficiency variances. Something to note here, what I mentioned was when you calculate, like for the labor efficiency variance, once you calculate the variance in hours here, it will be the same, including the sign, even here, variable overhead efficiency. You don't have to recalculate. It will be the same. Okay, so fast track, let me go to the solution. In the interest of time there. Labor rate variance. Okay, standard costs. You can use formula if you're comfortable, but as I said, we are using the descriptive approach. Actual, what you say here is on the actual side, you say 8,000 hours cost 168. You pick from the actual information. Then you say the same 8,000 hours, if you are stuck to the standard, what should they have costs? So you go to the standard cost card and pick the rate, labor rate. So 8,000 times 20 kwacha per hour, it should have cost 168, but you incurred it should have cost 160, but you incurred 168. So you incurred 8,000 kwacha more. So that's why it's adverse. Similarly, on labor efficiency, it's time. So I say that for efficiency variances, usage variances, make use of actual production. Make use of actual production. So they produce 11,000 units, which took 8,000 hours. If they are idle time hours, don't include them. For efficiency, variable overhead, you only include hours which were actually spent on production. Okay, but we don't have that complication here. Then you say 11,000 units took 8,000 hours. If they had stuck to the standard, the 11,000 units should have taken how many hours? So you multiply the 11,000 hours by 45 over 60. You convert the minutes to hours. Since you have 8,000 hours, like with like, you can't put minutes here. You can't put minutes here and compare with 8,000 hours. So you convert the minutes to hours by dividing 40 by 60, which gives you 8250 hours. So you end up with 250 hours favorable because you took less time. You should have taken 8,250. You took 8,000. You only took 8,000 hours. So you're efficient by 250 hours. Then you value those hours at the standard. Usage variances, efficiency variances, they are valued at the standard rates. In this case, standard labor costs. So you multiply 250 by 20, and you get 5,000 kwacha favorable. So what I'm saying is when you go to variable overhead, you don't have to recalculate again the 250. Okay, just use the same, but at the variable overhead rate per hour. Okay, so you move to variable overhead expenditure there. Again, you say 8,000 hours costs from the actual information, cost 132. If you had stuck to the standard, the 8,000 should have cost multiplied by the variable overhead rate per hour, 15, you get 120. So you spent more, that's why you have 12,000 adverse. Variable overhead efficiency, as I said, take the same 250, then multiply by 15, because the rate for variable overhead is 15, not 20. Since you are dealing with variable overhead, you use the same rate there. Okay, so all that I'm saying there is no need to calculate the variable overhead efficiency variance of 250, use the one from. Okay, so we take a short break there. Health break. And when we come back, we'll go to the treatment of inventory, which was also a problem at one of these dates. From the book, what's recorded in the book. I started almost 30 minutes, so about 17 minutes. Okay, welcome back. We move to treatment of inventory. For CA2.2 students, treatment of inventory is being encountered for the first time. But for DA9 diploma students, this is for a second time, and it's from the viewpoint of working capital management. It's found in unit 8, working capital management. So it's still relevant to DA9. So inventory levels, look at inventory levels, methods of valuing inventory, just-in-time manufacturing philosophy. Inventory control levels. Here, suffice it to say, you really need to know the formula. Without knowing the formula, you can't do justice to questions on inventory control levels. The formulas are not given. The formulae are not given. The formulae or formulas are not given. So you have to learn, short of saying memorize or something. Otherwise, the reorder level is calculated as maximum usage times maximum lead time. Then the minimum level is calculated, everything is minimum, so it's average. Average usage times average lead time. That's how we calculate the minimum level. For the maximum level, the formula is reorder level plus reorder quantity minus, in brackets, minimum usage times minimum lead time. Reorder level, it's one of the longest. Reorder level plus reorder quantity minus minimum usage, everything minimum in brackets, minimum usage, minimum lead time. Then the average inventory, okay, that one was not that's there. Reorder quantity. It's average demand per day times average lead time. Again, average demand per day, average lead time. And I'm saying there that without knowing the formula, it is impossible to perform calculation. And indeed, when the question was asked in the DA9 paper, it was a disaster. You could really sympathize with the candidates, just leaving it blank or just guessing. Yeah, some could try, but the majority could not. Then inventory control levels, economic order quantity, learn the formula. Again, the formula is not given. The EOQ is equal to square root, everything in brackets, 2CD over H, 2 times the order times annual demand divided by H there. Number of orders calculation, divide D annual demand by the economic order quantity. And costs are minimized where the ordering costs and the holding costs are the least. Also, some things that are examined here on inventory levels are the assumptions in the EOQ formula. So learn the assumptions, learn the assumptions. Valuation methods, methods of valuing inventory include FIFO, LIFO, and weighted average cost. First in, first out, last in, first out, and the weighted average. Learn the columnar format of ledger cards. That's the date, receipts, issues, and balance. Then the formula there. Particularly for CA2.2 candidates, they are doing this for the first time, or students. Whereas for DA9 students, they will have already encountered this at the DA5 paper. Keep memorandum cards, otherwise you can get confused when dealing with FIFO and LIFO. So keep memorandum cards for FIFO and LIFO to help you track what came in first or last. Then for the weighted average, something to note, you should recalculate the issue price each time there is a receipt. That's a principle there on weighted average. It's less cumbersome compared to FIFO, LIFO, P4, LIFO, except that with the weighted average, each time you have a receipt, not an issue, each time you have a receipt, calculate the issue price. Each time there is a receipt. There. Each time there is receipt, I've circled it. Yeah, okay. I'll recalculate the issue price. There is no need for a memo card here. Then also learn the advantages and disadvantages of each method. Then it's like you have completed the topic. You will have completed the topic such that whatever comes, you deal with it. If you just deal with calculations, you don't know advantages, disadvantages. Once these are examined, you lose marks. So then also the advantages and disadvantages of each method. Okay. Just in time, JIT, production philosophy. It's a pull system which responds to demand. The traditional system are push systems. They push materials. Even when there's no customer, they are pushing materials to the production and producing goods in the hope that somebody is going to buy. Whereas the JIT system is an inventory-less production system. You only buy the materials once there is an order. JIT purchasing, you only buy the materials when you see an order from a customer. And JIT production, you only produce when there is a customer waiting. What are some of the elements of JIT? You should know these elements. One, there are long-term contracts with suppliers, with a few suppliers. Long-term contracts, they'll be supplying for 3 years, 4 years, same. There is close relationship with fewer suppliers. And those long-term contracts, you phrase them in such a way that the suppliers themselves check for quality. When they deliver, the raw material should be defect-free. So work in close relationship with a few suppliers. Then one other element is that they are frequent orders, because you produce only when you receive orders. So you also be asking supplier to supply when there's an order. So in a GIT system, one element or one feature is that they are frequent orders. Okay. And some of the GIT advantages, such as cost reduction. For example, you don't have a big warehouse, so you reduce on insurance costs, you reduce on interest costs, money tied up. Then there are also short production lead times. Know some of the GIT disadvantages. So when you learn a certain method, or in this case like GIT rather, you should know the advantages and disadvantages. Then it means that you know what it is, also advantages and disadvantages. Not just what it is, because otherwise when the question comes, if the advantages, you ask for advantages, you'll fall short. For example, some of the disadvantages of JIT are risk of production disruption because you don't have materials. Not easy to predict demand. Okay. Also, it's not suitable for all organizations. For example, hospital blood banks. So for hospitals, better to have a traditional economic order system because, you know, when there is a bad accident, you can't start asking for blood. Yeah, we go out to look for blood. So, yeah, even some restaurants, you stock certain things like eggs. The customer asks for an omelette. You can now start asking your staff to go and buy an egg. Yeah, by the time they come back, that customer would have left. Okay, so that's JIT. Then illustrative questions on inventory levels, on economic order quantity, LIFO, and AVICO. These are common to both CA2.2 and DA9, Unit 8 for DA9, Working Capital Management. The question, if fast track, I take you to the requirements, it says calculate the reorder level, the reorder quantity, maximum level, minimum level, and average inventory. The total was something like 11 marks. No, 14 marks. 14 marks. And this was CA 2.2, Section B, Question 4, March 2024. Okay, so calculate that. Fast track, due to high demand, the warehouse keeper produced the following information. I've just read the last sentence. In the month of February, a warehouse keeper produced the following information. Demand per day, 800 units. Cost of placing an order, 21,000. Annual holding cost per unit. I think this can only be used for economic order quantity requirement. And similarly, placing an order, that's economic order quantity requirement. Minimum usage, that should be for the other inventory level formula. Maximum usage per day, 460. I think that will be for for part A. This is for part A. Minimum usage, maximum usage, lead time for replacement. When they put a range like this, it means this 2 is the minimum lead time and 6 is the maximum lead time. Okay, so this 800 also, I think, will be used for part A for the inventory level formula. Cost of placing an order, 21,000. Annual holding cost, yeah. That's for economic order quantity formula. Requirement rather. Okay, so if I do fast track, I take you to the solution. I'm saying there, recall of inventory formula is vital to gain maximum marks here. So one wouldn't do justice to this part of the question if one doesn't know the formula. So I really sympathize. You really have to know the formula. You really have to know the formula there. So those candidates in March 2024, they needed to know this, and the examiner's comment was that they did poorly there. So reorder level, maximum usage time, maximum lead time, we have that figure there. Reorder quantity, That is average demand times the average lead time. So the way you calculate the average lead time, you add the minimum lead time of 2 and the maximum lead time of 6, which is 12. Then you divide by 2. So 6, then you multiply by 800. 6 multiplied by 800, that's, sorry, 800 times. This is 12 divided by 2, that's 6. Sorry, 8, I don't know why I'm saying 12. 2 plus 6 is 8, then 8 divided by 2 is 4. Then 4 times 800, that is 3,200. That's 3,200. Then the maximum level, again, you're supposed to make use of that formula. Once you get the reorder level figure of 27, 36, 27, 60, and the reorder quantity, that's when you calculate the minimum level. That's when you calculate the maximum level, which is 5520. The minimum level is average usage times average lead time. We went through these formulas, so you just apply them. Since you had calculated the reorder level as 2760, then you calculate the average usage. So maximum usage 460 plus minimum usage 220 divided by 2, that will give you the average usage. Then times the average lead time, which we calculated as 4 up there in part 2. So the total is 1,400. That's for something like, did we say 11 marks? That's for like 11 marks. Examiners comment on this question. The question was not popular. Poor performance from those who attempted the question. There was poor performance from those who attempted the question. The reason is that most of them did not know the formula. So the warning is that future candidates should learn the formula. Then we move to part B, which is on economic order quantity. So I may have to take you back to the question. It says BG Limited uses 20,000 kgs of material A even over a period. It is purchased for 2.5 per kg. The cost of placing an order is 60, and the cost of holding 1 kg of material in inventory for the period is 15, and the period is normally 1 year, but the period there, okay, they just said period. 15% of the purchase price. So what is the purchase price? The purchase price you have been told is 2.5. So 15% of 2.5 would be the value for the H in your formula. It is purchased for 2.5 per kg. So the holding cost is 15% of 2.5. And then uses 20,000 kgs of material A even over a period, and the period could be 1 year. Normally D in the formula is 1 year. So this 20,000 kg should be for 1 year. And the cost of placing an order, so this is C in the formula. This is like C. 20,000 should be like D in the formula. And then this 15% is H. That's all you need there. And take the square root and so on. So fast track, I took you to the solution on slide 81. So there you have to set the formula. Normally, we give marks for the formula. The markers allocate marks for the formula because the formula is not given. If the formula is given, markers don't give marks. But all those, even the inventory level formulas that we have looked at in part A, they are allocated marks. There may not be a lot, but marks are given, whether it's half, anyway. Yeah, so there you multiply 2 by CD divided by H there. So 2 times 60 times 20, then divided by 0.14 times 2.5. Suffices to say there, it gives you 2530 kgs. That's what you should have calculated if you're in that exam. CA 2.2 candidates? Yeah, 2,530. That's the value of, yeah, and for those marks. It should be just a minute, should be some good marks there. 5 marks. Those are nice marks to get for such a short calculation. Then LIA4, part C. Part C. Part C. C2 actually, or C1. Calculate the total cost of 4 issues using the weighted average cost method. 5 marks. 4 issues. So stick to not all just the issues. You might not have to value the receipts and so on, just the issues. No balances, just the issues. Then 2, calculate the cost of inventory remaining at the end of. Inventory remaining means the closing inventory. Or the old language, closing stock. Closing inventory, CI. So also in that C2, or that they want you to calculate using LIA4, not FIA4. LIA4 is just the closing inventory. They are not interested in the issues, in fact. So again, for 5 marks, just one figure. So we are given, the question is on 76, slide 76. Receipts and issues of material be stocked by BG Limited over a 3-week period where, so we have week 1, 1, 1. Day 1, the brought forward balance was 900 with a total cost of 10,800. Then on the 3rd day, which could be a Wednesday in week 1, week 1, day 1 would have been Monday. Week 1, day 3 would be, say, Wednesday. They issued 400 from the 900. They issued 400 and 500 remained. Week 1, day 5 would be a Friday in week 1. They received 1,000 units worth 12,600. Then the rest, week 2, there were issues, including week 3 issues. Okay, so so in terms of the equation, calculate the 4 issues. Then in 2, calculate the closing inventory for 10 marks. These 2 parts for 10 marks. Okay, so if I go to the closing inventory solution again, a bit crowded, but what we are saying is keeping a memo card, as I said there, your brought forward units, 900 at 12. How do we calculate the 12? 10,800 divided by 900. So the price. For the memo card, you just keep the quantities as well as the price per unit. Quantities bought and the price. So it's a memorandum card there. So for day 3, they issued 400, which came from the 900, and the balance 500 remained. The rest of the issues were from the 1,000 lots. The rest of the issues were from the 1,000 lots. Again, just go first. Yeah, so if we check there, the rest of these issues, 260, 170, 370 came from the 1,000. Then 400 came from the 900. Okay, so the closing without producing a ledger card in a logical manner, for 5 marks, about 9 minutes. If you are fast, you can produce a ledger card. You won't make mistakes. But logically, if you don't want to produce a ledger card, all that we are saying is these issues totaling 800, 260 plus 170 plus 370 is 800. They came from that 1,000. Since it's LIF4, they came from that 1,000. So the what remained from the 1,000 is 200. Then from the 900, they issued 400. So what remained from 900 is 500. So all that you do then is the 500 that remained here and the 200 remaining there, value them. How do you find the price per unit? You divide 12,600 by 1,000, which is 12.6. Watcha, 12.6. Then for the brought forward balance, again, you divide 10,800 by 900, and you get something like 12 kwacha per unit. So the valuation of the closing, because that's what remained, of the closing inventory is 500 times 12 plus 200 times 12.6. That's what was required for those 5 marks for the closing inventory using LIF4. LIF4 last in first out, when they had just 900, that's what was there. So first last in first out, it's 400 from 900. But when the receipt came in there, week 1, day 5, the issues will be from the latest. That's what LIF4 is. Last in first out, the issues were from 1,000. They were not going to go to the 500 remaining there, unless it was FIF4. So this is the thing. So from there, if I take you to the solution, yeah. So that's a memo card. That's a 12. It's a reminder, memo card. That's what I said in the concepts there. Keep the memo card. No matter so you don't get lost. Otherwise, you get jumbled. If you are fast, you can do a ledger card and you still find the closing stock, closing inventory rather, would be the addition of this times this and the, oops, not that. The 400 times, sorry, 500 times 12 and 200 times 12.6. So first track there, that is the closing. Where's my, the closing is this 8,520 is the closing inventory, CI, using FIF4. Oh, sorry, LIF4. LIF4. Okay. Then the weighted average method, the principle is for every receipt, we calculate the issue price. For every receipt, we calculate the issue. So receipts are brought forward units at 12. So the issue price then in this case, therefore the issue price is 12. Because that's the only receipt you have. So it follows that that is the issue price that you have. Then the next receipt was in week 1, day 5, when they received 1,000 units. But when you receive this, you calculate the weighted average price. So this is calculated by the 500 units which remained when they issued 400 from 900 times 12, and the 1,000 units at 12.6 divided by the inventory in the warehouse made up of 500 and the 1,000. Okay, so 500 times 12 plus 1,000 times 12.6 divided by 1,500 gives us a weighted average price of 12.6, 12.4. So this is what you are going to use. Since there is no other receipt, this is what you're going to use to value all those issues, the they did. The 260, the 170, the 370 will be valued at 12.4. Then the 400, which they issued, will be valued at 12. So the cost of the issues come to 14,720, made up of the 400 issues valued at 4,800, and the 800 issues valued at 9,920. Actually, alternatively here, since the issues were 800, since the issues were 800, one way of getting the 9,920 is simply to multiply 800 by 12.4 to give you the same figure. 12.4. Yeah. To give you 9,920. Okay. So I'm saying there that NB stores ledger cards can also be used to answer this question, but they take more time to prepare. But for, actually I did a stores ledger card for the weighted average. That's this stores ledger card. So those are the issues. And when you add them up, you should be able to get the same 14,000. 14,000. Is it 700? Just a minute. It's 14,720. Yes, 14,700. 14,720. So if you are fast, you can still use a ledger card. Maybe you can ignore this. Let's see if you are, yeah, just up to here. Once you calculate this, that's enough. There is no need to calculate this. There is no need to calculate this. Just calculate, once you have that issue price, then value this at 12.4. Then add to the first issue. Okay. Otherwise, we move to the operating cycle, cash operating cycle, which is one of those issues where there were problems. I did that in the DA9 paper. Cash operating cycle or cash conversion cycle simply measures the amount of time it takes a company to convert its investments in inventory to cash. It is usually expressed in days, but can be in months. Can be in months. So you have to learn the formula again, because no formula is given in the DA9 paper. You have to learn the cash operating cycle. And the formula is inventory days, could be months, inventory days plus receivable days, minus, if they are production days, also you add, minus payable days, where ID is the number of days to convert inventory into cash. And ID is calculated as average inventory divided by cost of sales times 365 days. That's if you are using days. If you are using months, multiply by 12. If you are using weeks, multiply by 52. In the March 2025 DA9 paper, candidates were not averaging this numerator there. They were given the opening inventory and the closing inventory, but they were just picking one figure. Now the formula is average inventory, unless you don't have the information for you to calculate the average inventory. For example, if the inventory days are 18 days, it means that it takes 18 days to turn inventory into sales. Then the receivable days are calculated as average receivables. Again, if you have opening receivables and closing receivables, you have to calculate the average. So add those two figures and divide by 2 for you to get average receivables. Then you divide by the total credit sales. You should not include cash sales, just credit sales, multiplied by 365 days. So if the receivable days are 15 days, what it means is that it takes 15 days to collect a typical invoice, or 15 days for you to receive cash from your customers. And the payable days are calculated as average payables. Again, to calculate the average payables, you add the opening payables plus the closing payables, divided by the cost of sales. If you don't have cost of sales, the nearest is the purchases. Okay, multiply by 365 days if they are expressed in days. For example, if the payable days are 13, it means that it takes 13 days to pay suppliers. The cash operating cycle is a cycle where a company buys inventory, sells it on credit, collects its accounts receivable, and turns it into cash. From the above, it follows that the cash operating cycle or conversion cycle is 18 plus 15 minus 13, which is 20 days. The interpretation of 20 days is that it takes the company 20 days to turn its initial investment in inventory back to cash. Then you compare this figure with previous years or industry metrics, and it will measure the effectiveness of working capital management. As the 20 days are, it's difficult to say whether working capital management is efficient or not. You need to check what the days were last year. If there were 15 days, it means that now you have 20 days, the working capital management has worsened. Or against industry metrics. If in the industry they take, or the cash operating cycle is say 25 days, then it means that this company is efficient in managing its working capital. So again, we're saying you should not just know how to calculate figures, you should also be able to interpret. Okay. Then we look at a question from DA9 March 24 DAT, question 5, which was on working capital management, specifically cash operating cycle. The question says that CB Limited buys raw material from suppliers. The supplier allows CB Limited 1.5 months credit. Raw materials remain in inventory for 2 months, and it takes 2 months to produce goods. The goods are sold within a couple of days. Oops, I've got that masking. I need to bring it down. Oops. Sorry, I can't read everything there. Yeah, the goods are sold within a couple of days of production. Yeah, so the requirement is calculate the cash operating cycle for CB. So inventory months plus production months plus receivable months less payable months. So inventory months are 2 months, production months 2 months, receivable months 1.5, payable months 1.5 months. So the cash operating cycle is 4 months. The cash operating cycle is 4 months. cash operating cycle is 4 months. Again, a figure on its own like that is on its own, you cannot interpret whether it's a better figure or not. Okay, then we move on to the last portion here, flexible budgets. Yeah, variable costs vary with activity. Yeah, in cost classification by cost behavior, variable costs vary with activity, fixed costs don't vary with changes in activity levels. Semi-variable costs are partly variable, partly fixed. Flexible budgets are prepared at different activity levels. They are what if approach to budgeting. Analysis of costs may reveal that some costs are wholly variable. These we should flex them. Those that are semi-variable, use the high-low method to split these costs into fixed and variable. Only flex the variable part. Okay, now how to recognize fixed costs, variable costs in a scenario question. I've done a schedule here, how you recognize those. What you do when you are given a question, the sales price per unit, sales revenues, divide them by the activity levels. That's what I'm saying there. Let me get a pointer. Sorry, we should be finishing soon. Let me get a pointer. Yeah. Yeah, so sales revenues divided by the activity levels. If the figure is constant, then your conclusion is that it's wholly variable. Then in that case, you should flex. Similarly, for materials, divide the material cost by the activity levels. If the figure is constant, it's wholly conclude that it's wholly variable. And it means that you should flex. Labor, if you find a constant figure per unit at all levels, then by constant, you find maybe 10 kwacha, 10 kwacha, 10 kwacha at the activity levels of 15,000, 20,000, 25,000, 10 kwacha, 10 kwacha, then it means it's wholly variable. Then you should flex such a figure. That's what I'm saying. Production overhead costs, if they are not constant, then it means that they are semi-variable, and therefore you should split such costs. Other costs, you may have to do them by inspection. If they are constant at all levels, then it means that they are wholly fixed, and therefore don't flex them. The rule is that you don't flex fixed costs. Okay, so if we look at the last question there, CA2.2, CA2.2, parts A and B only. Fast track says Langua bicycles, LB, manufactures bicycles output levels, varies from month to month. No inventory is held. Langua Bicycles Limited Finance Department prepares monthly management accounts used for performance evaluation. Budgets for different monthly output levels are given below, together with actual figures for December. For December 2021. That's I think it's going off. But this is my last year. I don't know whether you put it.
Is it
my computer, yes.
So
Yeah, I mean to put it where, because it's not receiving power. Yeah. Sorry for that, ladies and gentlemen. Together with actual figures for December 2021. So That was the question there. So this is the actual these are the actual figures. Then those are budgets at different activity levels. Activity levels are 15,000, 15, 20, 30. Then the actual activity was 25. So those are the figures. So what I was saying was in testing whether a particular variable is variable or not, or activity figure is variable or not, you divide this 7.5 by 15, because this is already in thousands. Then 10 million by 20,000, 15 million by 30,000. So if the figure is constant, then you have to flex. It means it's wholly variable. Similarly this. So if fast track, if I take you to the way I tested, prepare a flex budget for the month of December 2021. So you test. So I was dividing there. When I divided the sales price, I was getting a constant 500. For materials, when I divided, I can go back. When I divided 4.5 by 15, 6,000 by 20, 9 million by 30,000, I was getting 300. So it's constant and therefore it should flex. Similarly, 900 by 15, because this is already in thousands. So 900 just by 15 and without including thousands. 1,200 by 20, I was getting 300. So it was wholly variable and therefore flex. Okay, so fast track, if I take you to this. So the workings, these were the workings. 7.5 by 50, I got that figure. 4.5, I get 300. 900 by 15, I get 60. So they were constant. So I flexed this. You multiply by flexing, you multiply the actual activity 25 by 500 by 300 by 60. Then indirect labor, when I did that, it was not constant. So I used the high-low HR, variable cost per unit. Use high-low method. The highest level, the lowest costs. Highest level, lowest. And I found 12.53 per unit. This is the variable costs for indirect labor. Then the fixed cost, to get the fixed cost, get one of the totals. Doesn't matter. You can start with 2. You can use 2H1. But if you use 2H1, then you have to multiply by 15. If you use 469, you multiply by 30. So the fixed cost is 93.10. Don't flex this one. We don't flex, but flex this one. Indirect materials already fixed, not changing at all levels of activity. General rule, don't flex, fixed costs. So if we go to indirect materials, 1125, 1125, 1125 at all levels. It means this is wholly fixed and you don't flex this. You take the figure as it is to the flexed column of the solution. Okay, so there we are. So in terms of the solution, it had asked for a flexible budget. So you flex 25,500, 25. By flexing, that's what we mean there. The same actual activity level, you use it. 25 by 500, 25 by 300, 25 by 60, 25 by 12.53. Flex. Then 93, 100, you don't flex, you just bring it as it is. So the total was 406 there. Then indirect materials, again, you just bring it as it is. You don't flex. So the flex profit was that much. Okay, then part B. Part B. Calculate revenue, costs, and profit variances for December 2021 using the actual figures given and the flex budget you have prepared in A. So that's for 3 marks. Maybe it was mean because figures were just being copied. Only 3 marks there. Maybe okay. So that was the budget control statement. And this one is what is said to be meaningful because you are comparing like with like. Like with like, the 25, you compare with the 25. Then that's like with like, and the variances are then said to be meaningful. Okay, so revenue there, you raised 15, you should have raised 12,500, so you did well there, that's favorable. In terms of direct materials, you should have incurred 7.5 when you flex at that level of activity, you should have incurred 7.5, but you incurred 89.55, so you spent more. In terms of labor, at that level of activity 25, which at which you operated, you should have incurred only 500, of course in thousands, but you incurred 2,100, so you incurred more. That's adverse. Indirect labor should have been 406, but you incurred 675. You incurred more, adverse. Indirect materials, you should have incurred 1125, but you incurred 1,450. You did badly there. So only revenues, but that was not enough to absorb the cost at the operating level, at the shop floor level, at the factory level. Sales revenue, guys did well there, but the factory level, you did badly there, or they did badly there. You should have raised 1968.65 profit at that level of activity, 25,000, that output, but you only raised 1,820, or in full, 1,820. So you were short by 148.65. Adverse. So you performed badly there. So that's how you go about doing flexible budgeting questions. In conclusion, I should say, I hope the tutorial notes and helping guide have helped you to follow the calculations and explanations in doing these questions. For full solutions, check the Zika CA2.2 and DA9 revision kit and suggested solutions on the website. Okay. I should just add to say, to pass the demanding Zika CA2.2 and DA9 exams, you need to be hardworking and methodical. Prepare a study timetable, a revision plan, and regularly practice exam-style questions. Do not forget the exam techniques we went through, such as gaining easy marks. Good luck in your forthcoming examinations. Thank you for listening, and I should apologize for starting almost 30 minutes late. But thank you very much for your attention.
Okay. All right. Thank you so much, Mr. Xiong, Mr. Mwansa. We have come to the end of the examination techniques. That was a good presentation by Mr. Mwansa. Like he has said, we hope we have picked very important points there that may help us during the coming examination that will be starting on the 9th to 13th. And we really wish you good luck into your examinations. Thank you so much for your time and for your attendance to the exam techniques. We wish you all the best once again. Thank you so much. This is Bye from Zika. Thank you.
Good evening. Good evening, Mr. Mansa. Hello, can you get me, Mr. Mwansa?
How are you, sir?
I'm okay. How are you, sir? Thank you so much for the presentation.
You're most welcome.
We greatly appreciate.
You're very welcome, and I'm humbled. I wish you the
Yes.
very best in the exam.
Thank you so much.
Yes. If you
Yeah,
have any
I
other
dropped
queries,
something in
maybe you
the.
can talk to the
I
Zika
dropped.
people, and I can ably answer some of your questions. Yes. But if you have
Okay, I
some
dropped
questions, you
something.
can.
I dropped something in the chat box. I joined the meeting late, unfortunately. So I just wanted to find out: is there any arrangement to share the recording of this meeting after the meeting is done to our emails or something?
Yes, it will be shared. It will be shared. I don't know which day, or whether it's immediately but it will be shared. The
Okay, thank you so
slides
much. No,
will be shared. Yes.
waiting.
Okay. Okay. All right then, sir.